Hi, I'm Lauren Taylor, Managing Director of Active Property Group. In this video, I'll discuss what determines the return on investment for our pooled mortgage fund. The ROI for pooled mortgage funds can vary widely depending on various factors such as the fund's investment strategy, the overall economic environment, and interest rates, amongst others. Mortgage funds typically invest in a portfolio of loans secured by a mortgage and generate returns through interest payments by the borrowers. At APG, our pool mortgage fund is used to lend out to a variety of business borrowers. On average, we usually have around 30 different loans in our portfolio, all of which are secured by Australian real estate. Returns to our investors are based on the interest rates paid by the borrowers on their loans, and investors receive these in the form of quarterly distributions. Investors may also opt to reinvest their returns to compound their interest over time via the Distribution Reinvestment Plan, or DRP. Because the interest rates vary depending on the loans in the portfolio at any given time, which is based on the loan type and risk, returns to investors will also vary. The cash rate set by the Reserve Bank of Australia, or RBA, also plays a part in the rates paid by borrowers. Whenever the cash rate goes up or down, the increase or decrease is passed on to new borrowers who take out a loan and to existing borrowers who extend their loan. Generally, the returns for a mortgage fund will be 3 to 5% higher than the cash rate set by the RBA. Another factor that will have an impact on the returns for a fund is the number of second mortgages included in the portfolio. Second mortgages are inherently riskier, so therefore have higher returns. At APG, we target having around 25% of our loan portfolio as second mortgages. This helps us to deliver higher returns than a standard first mortgage fund while also balancing the risk. Lastly, the number of loans in default will also play a part in the returns delivered by the fund. If there are a number of loans in default and it appears there may be a risk that the loan amount or all the interest owed won't be recovered, then a provision for doubtful debts may be raised, which can reduce the return. Keep in mind that APG does everything we can to mitigate this risk, such as using conservative loan-to-value ratios. On the other hand, if a borrower does go into default, then they are liable to pay higher interest after they go over the due date. So once the security property has been liquidated, then the investors will receive a share of the higher interest paid by the borrower, which has a positive impact on the return. If you have any questions about our most recent returns, then please get in touch with the Investor Relations team at investorrelations@activepropertygroup.com.au. Thanks for watching and see you next time.